my audience knows Norm more than my audience knows you, because you spoke only once at the Rosewood. But Norm has been speaking at GTS for, what, a decade?
Yeah, 10, 11 years ago.
10, 11 years, like, can you see
a
picture to prove it? This is Norm. This is Dick Kramlich, who is actually a founder of NEA, where Ben used to work. So Ben, we'll start with you. I know you've been as Dick Kramlich is right there.
There's the man.
Yeah.
Bill Draper and Fish Johnson up there.
Right.
It's a good group.
I know. And you're a part of it now. So you've been a CEO, then you were a partner at NEA, and now you started your own fund, Tenacity. Love the word, love the name. Did you come up with it yourself?
Tenacity has always been something I believed is critical to entrepreneurial success. When I was starting the firm, I had a different name in mind. I sort of code named it because I was inside NEA at the time, and we talked about me spinning out to start the seed fund. And so I code named it Purple Octopus. Because when I would do a lot of presentations to young entrepreneurs, and the two comments that came up were sort of, one, how do we fix the diversity challenge, and two, how do we fix access? Well, I have my own way of fixing the second one, but I used to say, look, I really do not care where you came from, what you look like, where you went to school. What I care about is that you're brilliant, driven, focused, tenacious. One day I hope to fund a sentient and sapient purple octopus to prove to the world that whatever's on the outside is totally completely irrelevant. And so people like that for some reason. I decided purple octopus. And then my wife and daughter said it's the stupidest name I've ever heard, and I don't like it at all, and you need to come up with something else. So I actually ran a poll on Twitter and LinkedIn and got like 1,000 votes between Purple Octopus, Electa, which means the chosen one in Latin, which is my daughter's name, and Tenacity. And Tenacity won. And even more importantly, at least half a dozen entrepreneurs reached out to me personally by text or by phone to say, you've got to go with Tenacity. It defines our life. It defines you. It's every entrepreneur understands what it means. And
so you've been an entrepreneur and an investor. You worked for a big fund, and now I don't want to ask you about the size of your current fund, but you've been.
No, that's fine. It's a $50 million fund. I've been doing seed investing for 14 years. And while I was at NEA, which is a very large fund, and while I was at Canvas, which was a very small fund, we would have a lot of discussions about pace. Normally, a venture fund, tell me if you think I'm wrong, takes about 3 years to deploy. Recently, it feels like it takes about a year or 18 months. It's going crazy. Well, I've had both sides of the argument, and I'm always quizzical about this, because the way I think about it, pace in venture should be irrelevant. If you are holding the bar at phenomenal, who cares how many companies you fund? Imagine that you thought you should fund one company a month, and then Google and Facebook both walked in the door. Which one are you going to say no to? I mean, the problem is that venture was not built for good companies. It was not built for great companies. It was built for truly phenomenal companies and founders that can go on to create world-class future public companies with no limits to their size. Okay? If you truly practice that, you should fund every one of those you find. What happens, though, is people start to, well, maybe, or and they sort of talk themselves into making investments. And so they make good investments, very good investments. Wrong, right? Wrong decision. So you shouldn't have to worry about pace if you keep the bar high. Having said that, your pace is tied to how much money you have. So I looked at how many deals I do a year, about 7 to 10 out of about 2,000 pitches. I looked at how much I'll invest on average, $2.5 million, multiplied that by 3 years, and that gave me a $50 million fund.
It's easy to have those pacing discussions when you're the sole partner in the fund.
Yes, and then I now have a new guy who's a young guy who's really been very impressive, and I've known him for a few years. This is going to be my venture partner, and so now I'm like, well, how do I now think about it? So now we got to figure out whether we add 10 to
do a deal something.
Yeah, well, so I'm looking at deals with him to sort of see how I think about his pace, and then we'll add 10 to 25 to the fund, because the fund's already oversubscribed. It's just a question of picking who and how much we take from them.
Sorry, guys, he's not taking your checks. So.
I'm still, look, I promised to take meetings till January 1, long before I knew I would be oversubscribed, so I'm still doing it, and then I'll allocate appropriately. Because what I've learned is, it's funny, so every VC says they're value add, and most of them aren't. And every LP tells you how they're going to be useful, and almost none of them are. Well, I've already found that some of my LPs are really useful, and so I want more of those. So my attitude is, let me get all the demand together. Let me interview those LPs. It's funny. My young guy took me out to dinner with a scion of a $200 billion family, and we were talking. I was asking Scott all these questions, and later he sent my venture partner a note. He said, Ben is the first person in 4.5 years that made me justify why he should take my money. It's like, yeah, but there's a lot of money out there right now. And I would like that money to come with more than money. I'd like it to come with help.
Oh, yeah. Norma, you've been doing it, what, 40 years?
40 years and counting.
Not to date you, but you've seen ups and downs and everything in the industry pretty much. Will you comment on like what stays the same throughout and what changes have you seen and why did you end up being a venture capitalist?
Thank you. I'll start out with, and it's fun to be here, so thank you for that. Are we on here? Ben, I'll just pick up where you left off, and I'll go back in time. But I agree there's a flood of money out there. I mean, just a ridiculous amount of money. Maybe there can never be too much on the one hand, but in terms of what the opportunity is, there's probably too much right now. And it's going to continue, and there'll be even more as long as the Federal Reserve and the world central banks keep interest rates at zero. I mean, that makes no sense. There is a time value to money, and when you say interest rates at zero, you can make no money in the debt market. Then you could look for equity, either venture or other forms of equity. So we just have this huge flood. Now, the good news is there's a lot of entrepreneurship, and maybe some companies, the ones that are not truly phenomenal, just kind of great, are also getting the money. And so we're going to see a wonderful wave of entrepreneurship, and new things are going to develop that we've never seen before. But it's a very unusual time, and I can say that, speaking personally, almost as long as these gentlemen right here, that it's a fantastic, just fantastic opportunity if you're an entrepreneur, and if you're raising a new fund. In terms of how this whole industry grew and started, it was a very small business. I mean, when Bill Draper and Pitch Johnson were starting out, I mean, they had like a $1 or $2, maybe $3 million fund back in the 50s, and almost all the funds were $3.5 million back then, because that's all the money the government would let you raise. The most you could put into venture capital was $100,000, even if you were wealthy, and you can only have 35 LPs. So all the early venture funds were $3.5 million back in the late 50s and early 60s. That grew over time, but that just gives you a sense of how small the business was. And when I was getting out of graduate school, there were maybe 30 venture firms on the West Coast and another 1 or 2 dozen on the East Coast. And each of those firms had 1 or 2, maybe 3 partners. I mean, today there's, thousands of people just in the San Francisco Bay Area alone. So that's a good thing, but the scale of funds has just increased as well as the size of the organizations. Our first fund back in 1980 was a $22 million fund, and then there was a $40 million fund, and they get bigger and bigger. We just closed IVP 17 at $1.8 billion. We've raised $8 billion over the last 20 years. So it's been phenomenal, and the deal sizes get bigger and bigger, the checks get bigger, but also the opportunities are phenomenal. I mean, today, with the internet and everything else that's coming beyond that, it's just a richer time than we've ever had in the venture community before. So I'm very excited about it still.
And I just want to point out that the very fact that these funds, I didn't ever know that $3.5 million limit. That's great. I love to have these tidbits. The fact that the funds have gotten so much bigger is what created the opportunity for seed. When I moved here in 2003, I was really enamored of the entrepreneurial community, but it wasn't until a little bit later, around 2007, when I noticed this huge gap in the market between these very early investors called angels, who would take forever to write these teeny tiny little checks, and venture firms, which had gone from what I thought of as sort of the 90s, $100 million funds to $1 billion funds. You don't grow venture funds quickly, right? You might be able to raise a lot more money, and we could argue about whether that's the right thing to do, by the way, but you're not going to just get bigger by hiring more people. Hiring people in venture is a nightmare. It takes forever. You're planning on being with them for 10 years. You know, nobody fires anybody in venture. They have tricks to get rid of them, but, you know, net. And so you have to write bigger checks, as you pointed out.
You're exactly right. You're worse off. If you have the same number of people and you have the same amount of money, that's great. If you double your people and double your dollars, you're actually worse off. You know, 5 people with a $100 million fund is better than 10 people with a $200 million fund because of the diseconomies of scale. You have to spend more and more time talking to your partners, looking at their deals, they're looking at your deals. You're spending less time looking out for those phenomenal entrepreneurs. It's not obvious, but you're absolutely right. You have to grow slowly.
And that gap is why seed became something. That's why I started one of the first institutional seed funds in the world in 2007. So that was an opportunity that was created by the sort of systematic and formulaic change of the way that venture grew. Because before, I mean, let's face it, you know, like when I started out, Series A's were, you know, $4 million. I had a VC once say to me, "Oh, I'm so sick of you seed guys. I'm getting priced out of the market. I just had to pay $8 million pre for that company." 8 pre? We had a deal come in before I left NEA where the partner bringing it to the table said, "Look, it's a really great opportunity." Person grew from 0 to 2 million in a year. So it's going to be a middle of the round Series A, you know, about a $60 million valuation. Middle of the road at 60. Come on. I remember complaining to an entrepreneur. I don't follow on. I'm a one and done guy. But in the old days, I would occasionally. And so I'd funded him at 1 on 3. That was a classic seed deal. And he raised, actually from NEA, at like 4 on 8 or something. And I'm sitting with him. I close by check because I like to celebrate. I like to shake your hand. I like to toast. And I'm writing this check. And he's like, what's wrong? Because I'm looking grumpy. And I'm like, what do you mean what's wrong? I just put in money at 4 6 months ago, and now I got to give you money at 8? What do you think's wrong? I'm giving you all this extra money at this huge price. And he's like, but I just marked up your deal. I'm like, do you see me getting cash here? This isn't liquid. This is me
It's
putting
dilution.
money in. You know, so it was, but it's so funny to think about how I once told an entrepreneur that was pitching me, he said, pitched me, I was super excited. And I said, well, tell me about the terms. He said, well, I'm going to do a capped note at 10. And I was like, oh, I'm so sorry. I wish you'd told me that at the beginning. I think my words were, and this tells you what an idiot I can be, and maybe I'm arrogant. And I said, I don't care if God above comes down and pitches me a business. I'm not paying a 10. And now, 10's cheap.
Yeah.
But
Well,
if you
yeah,
could
the
go
other
back
thing
in
that's
time, you
changed.
know what you always tell your younger self over the last 14 years? Do all the deals. Every deal I got serious about, I should have done every single one. There's not a company that I spent 6 meetings with that I shouldn't have funded in terms of how things worked out.
May not be the best IRR, but a great multiple.
Yes. Well,
The perpetual trade-off between IRR and multiple in the business. The other thing that's happened with this change of dollars is just the actual interaction with people within the industry. And it used to be that you had to get your friends together to do a deal. 3, 4, 5, there were typical syndicates where asset management or IVP or NEA would do deals together. And as the firms have gotten larger, that's kind of gone away. And now it's like we're going to race to do the whole deal. Maybe we'll cut off a little piece for somebody else.
we just I had a company called Rippling, which I funded. It was the highest price I've ever paid, by the way.
Was it when you were in NEA?
No, I funded them personally. It was not going to be an NEA deal. The founder had he was the founder of Zenefit. Some things happened. Anyway, I funded his next company, and he just raised it $6.5 billion valuation. The company's about 3 years old. And I reached out, one of my LPs said, hey, can we put some money? And I said, oh, I'd love to, but let me check. I knew the answer. It was like, hey, can we put like $5 million in for my new fund? Not for me, but for my LPs. I do all my follow-ons through SPVs with my LPs. And he said, yeah, I'm sorry, Sequoia took it all. $250 million in it, 6.5, and there's room for 0 people.
Yeah.
You are actually one of the people that I talked to before I became somehow related to venture. You and Scott Sindel, and you both gave me similar advice in a couple of ways. What you said is be very careful.
Scott Sindel is a partner at NEA.
He pretty much runs the firm. He was Dick's mentee, and now
Yeah.
He
runs
was
the
a panelist last time we had GTS.
He's a great guy, phenomenal mentor. You both said be very careful about your syndicate. You have to worry about syndicate risk. In the old days, you knew your syndicate. You picked them.
Yeah,
And now, you don't know anybody. They just show up, if it's, I won't name firms, lob $100 million over the fence with a term sheet attached to it and a please sign here, I've never met you before.
like the Dilbert cartoons, yeah, right?
Pretty much.
But how do you stay in the deal if you're an early stage fund? I know that Norm shows up later with a bigger check.
Super
How
smart
do you-
model.
Yeah.
We literally have the exact opposite model, but I think both work.
Complementary.
Yeah, you come in late. Like whenever I explain IVP or the evolution of business, I always credit you as the first of the late stage VCs, the guy that came in one round before the IPO, put the money in, and made a great return. Okay, but great IRR and a great, probably decent multiple. I'm the guy that goes in the first round. I want 40 to 100x. I only care about multiples. I believe that if I can get you 40 to 100x, I'm going to get really good IRRs. So I'm not that worried. But I'm not following on because I don't want a lower multiple. I have a finite amount of money. I got a $50 million fund. I would rather do 10 deals that have the chance of being 40 to 100. Some of them I'll lose all my money. But when I make it, see, the normal model for venture is you put in 2 and you reserve 4 or 5 or 10, right? And I used to argue with my guys all the time, not at NEA or at Canvas, but when I was running the Triple Point program, like, just put it all in at the beginning. Why would you trade a 40x for a 20x? Well, it doesn't make any sense to me. Well, we might lose all our money. Yeah, that's the way it works. But when you lose all your money, you can only lose it once. When you make 40x, let's get as much. There's a saying in poker, which you might know, since
They
Norm's a
play
great
poker.
poker player. We started a group
bit.
together. The money you lose is the money you don't bet when you win. Right? Winning a hand with $5 in the pot is meaningless. Like, you get all the way to the river and you scrape back that $5, but you're no, let's get real money in there. It's not how many hands you win, it's how much money you win. So I like to go in early. Now, I don't want to not take advantage. It's just that, so if I'm shooting for 40 to 100x return on a startup. If there's now, I just said I would have been willing to put money into Zenefits at Rippling at $6.5 billion. I still think there's another 4x from here. Doesn't fit my profile. But it'll be great for my LPs. It's more of Norm style.
But how do you make an exit? Because at some point you lose control, don't you?
Oh, I never have control. Nobody has control except the entrepreneur. Unless you're willing. See, here's the thing that I think is mythical. Well, I do tell my entrepreneurs that you have to be so careful with who you take money from. Because when you raise your Series A or beyond, you are signing a one-way prenup. And it's not a one-way prenup to your advantage, right? They can fire you, you can't fire them. If you're not willing to exercise that nuclear option, though, the only way you can really, maybe it's different later stage, tell me, the only way you can really influence your entrepreneurs is through trust and respect. There is no tell them what to do, right? You can tell them what to do all you want. I think it's the wrong answer. And, it has to be their thing. But if they say no, the only thing you can do to make sure they do it is to fire them and replace them. I was forced to fire an entrepreneur once on somebody else's behalf. I have never fired an entrepreneur. I want to bet on phenomenal people and let them go. Now, it doesn't mean I don't help. Doesn't mean I don't have a fiduciary duty. It's just, if you believe, here's a hard lesson I learned early. If you need to be in the deal for it to work, you're making a mistake investing. If you can be additive, if your entrepreneur needs you there, you shouldn't have funded them. If they value you being
Norm
there.
has to say something about that.
No, I appreciate there was a subtle point that Ben made here, which is good, which is how different firms are working together today. And you're doing a spectacular job of seed investing, as you've been doing for quite a while now. But when you do need subsequent rounds, you can either get another venture firm to come in, or venture firms, different firms, will put together a special purpose vehicle just for one of your deals. And so that's how you get protection from the follow-on rounds of financing there, is to have friends who will put money in at a fair price and with fair terms. And so his model works as long as there's other people that will continue to fund the
And
company.
I will do that. I will do this SPVs with my LPs so that we can continue to support the entrepreneur. I protect my multiple, but I give them access. And by the way, this is something I found quite common. The reason I baked it into the fund was over the last two funds I've worked for, every deal I did had LPs investing in those deals. We've got a deal right now, I won't name it, but last round was at about $1 billion. Next round should be, it's already spoken for at about $4 billion or more. And there'll be $100 million from a firm and $100 million from their LPs.
And you show up there with your what?
Well, that company, I believe, has unlimited upside in it still. So I will go to my LPs and say, this one is a super wow. You tell me how much you want. I'd love to show up with a $100 million check. That's up to my LPs, though, because I don't have one. $50 million. It's not like I can go to SVB and say, hey, can I take this $50 million and just lever it up to 100 and put it all in this one company? Because I think it's a good idea. And then maybe he looks at me and says,
You're lucky because I have a check in my pocket here. So.
Oh, awesome. Oh, there you go. There's the other 50. I'll put 100% of the fund in. It's sort of like there's people that focus on barbell strategies early and late. I think some of them have done a good job. A lot have not. But it's the old saying, I think it was Peter Drucker, stick to your knitting. I know this space. I enjoy and believe I've shown some success in the 0 to 1 phase. Between 63 and 71% of the companies I funded in the first 9 years went on to raise follow-on rounds. So basically, I see them. They raised a Series A. I've never met anybody that can claim anything close to that. That's not fair. I met one guy. He said, I have a similar track record. I was like, really? Because I've been asking people for 14 years. He said, we were almost there. I was like, how many companies did you fund? 4. I was like, I funded 109. So, I don't know anything about sports, but I think that's called little ball or something, where you go play with plastic.
Softball.
Yeah.
So Norm, you mentioned something about the federal control of something. Can we discuss what's happening in Washington, D.C.? We don't, we're...
Why ruin the whole day?
We need some of Ben's wine and some of his cheese, and we can have a long conversation maybe later tonight. So I'll try to be apolitical, as objective as I can, and I'll say that because I'm on the working group of the NVCA, National Venture Capital Association, and we're working on the capital gains implications of what the tax legislation is going to be. Whatever happens, there's going to be a lot more spending. Some people would like far more, others would like less, but nevertheless there will be more money coming in. And the question is not sort of what's there, which is important, but also how do you pay for it. I think as of this morning, the conversation was, we have a framework, but we don't really know how we're going to pay for this. So that's like 30 minutes old news. But in particular, when you think about how do you pay for an extra couple of $1 trillion, where do you get the money? It's coming from corporations, from other sources. And then they're saying, we're just going to tax the rich, and we're going to take it all away from the billionaires, we're going to take it away from all the venture capitalists and all the entrepreneurs and all the CEOs that made a lot of money, and we're just going to fund it that way. And we're going to do that by eliminating capital gains, or eliminating QSBS, or any of a number
Is
of other
it really
things. Or
happening?
Well,
I
today
don't-
actually they now said that I'll be less balanced. I'm disgusted by our entire political system. I believe it's the best in the world, but that doesn't make it good. First of all, I don't trust any politicians. So maybe they got into it for the right reasons, but they didn't end up staying there. It's just horrible. At this point, I'm advocating for only one thing, and that is gridlock. I hope we get to the point where they can't do a thing. Just freeze it down.
I wouldn't disagree with that, but just to finish my comment, the thing that would be even worse than what I just discussed is if they decide that they want to tax unrealized gains in your
This is
assets.
what they're trying to do
If we
now.
have a nice wine cellar, or a nice car, or a nice house, or a great stock portfolio, and we haven't sold any of it, but it's gone up in value, they want to tax that. And that, I think, would just destroy the economy. And I will say, having been on the NDCA board before and now, I've never seen so much anti-capitalist animus in Washington as there is today. And it's not just, how big should the tax or what the rate should be.
You said it. We have some people who actually grew up on the socialism sitting there and they're nodding their heads. They don't like what's happening here.
So we're not headed in the right direction. Hopefully we can course correct
It's also
there.
short-sighted. Like I wrote a story for Business Insider. I was going to go on CNBC and talk about the capital gains point. I'll give you a true world example because I always think stories that are actual are better than mythical. Like, oh, what if? All right, so I invested in a company. How many people here by show of hands know what QSBS is? Okay, some people don't. Basically, if you invest in a company that has under 50 million in assets and you hold it for 5 years as C company stock and you sell it, you can reduce your capital gains by 50 to 100%. It was an enormously valuable thing the government did to encourage people to invest in high-risk companies, where if you're wrong, you lose all your money. So it's a very fair thing. I mean, I love it. They've tried, now they want to reduce it to 50%. It was 50 when it started, it went to 100%, and now it's going to come back to 50, they claim. I'm fine with 50, whatever. But here's the story. So you have to hold the stock for 5 years, right? I had a company I invested in. 2 years later, I sold the company shares that I had for 42.5 times what I had paid, okay? Now, because it's only been 2 years, I can't take the capital gains advantage of reducing it by 50 to 100%. But I can reinvest it under QSBS rules, keep credit for the 2 years, only have to have 3 years, and then defer my capital gains down the road. Well, I'm not sure I've ever been more motivated to push money out the door than during the 60 days I had to do that. Like every check I was going to give, I doubled in size. I'm like, instead of taking 8 meetings a day, I'm taking 16. I want that money invested. Even though I know when I'm wrong, I'm going to lose all my money. I lose all my money about 25% of the time. So I'm motivated to put money into jobs, companies. Like, I know people talk about jobs. What do you think? 50% of the U.S. economy is SMBs. SMBs are all startups of some sort. 48% of all jobs in the United States come from SMBs. You want to disincent me from reinvesting that money? I had $1 that's now 42.5 that I want to shove back into that economy, and you want to shut that down? By the way, do you think I am so stupid and unable to hire people that I'm just going to write you a check and call it a day? No, I'm going to use people like, charitable remainder trust. I mean, there's going to be a place to make sure that money is utilized in a way that's not just dumping it in a hole. And by the way, even if I did pay the taxes, okay, great. Once and it's done, the minute I pay you those taxes, they're off. Those dollars that are post-tax, those aren't getting risked again, man. Those are going into a lockbox, right? Because once they're post-tax, I'm like, oh no, I'm not going to touch them.
And then I just highlight, this is not just for Silicon Valley. I mean, this is for any entrepreneurship activity, and it could even be, a chain of hardware stores in the Midwest. There doesn't have to be something technological here. So these tax provisions, filter across the entire country. And I share some of your passion. I won't be quite as negative on the process, but yeah, I share some of your passion that people go to Washington to get rich, and we have some politicians that we know that have gotten
Yeah, it'd be
very rich
nice
going
if
to
they
Washington.
disclosed their asset base before they entered office, after they exited office, and every year thereafter for a period of 5 years. Oh, wait, the Clintons are worth how much now? They were on the verge of bankruptcy, right? Literally, edge of bankruptcy and now hundreds of millions of dollars. And by the way, I won't go there.
Yeah, and the insider trading. I mean, if you're in
Yeah,
Congress,
yeah.
you
I
can
mean,
engage
it's
in
just-
insider trading, and somehow just before all these electrical provisions go through for the cars, certain, not going to name senators or congressmen right here, they make very timely
I'm
investments.
sorry I asked.
Yeah, I told you you ruined it. It's just all agita.
Are we on the first question? So
Let's get back to entrepreneurship.
Yeah, okay. All right, let's go back to entrepreneurship. Several years ago, like in 2015, the world had about 142 unicorns. Several years later, we have 800 unicorns. And then we have companies like that famous Chinese company with a valuation of 140 billion. Now we have our SpaceX, which is over 100 billion valuation. We have Robinhood, for where you would invest in over $1 billion. And like, why? Why is it happening so fast? Why?
I think that things just generally get bigger over time. The world's population is getting larger. We're approaching 8 billion people. And I think in this particular case, it's a little artificial just to say, oh, it's $1 billion, so you're a unicorn, you know, and then you're a decacorn because you've got 10 billion. And most of the audience is a little young here, but there was a TV show called The Millionaire. If you remember this back in the early 60s, a wealthy person would anonymously go out and give $1 million to somebody. Just anybody in any life. They could have been a clerk, they could have real money. He was a wealthy man and you never saw his face, but you just saw him give money to these people. Once a week there was an episode, it showed how their life changed when they received $1 million. Now today in San Francisco, $1 million buys you about 1/2 of a house. Not that we each wouldn't like to get $1 million. Now if you run that forward to this current time, and this person, we're not giving away $1 million, but $1 billion. $1 billion might change each of our lives if we got $1 billion. And that's how important $1 million was back then. There were no billionaires. They didn't exist. And now we have billionaires. Now we have people who are worth hundreds of billions. And I've talked to my kids. There will be trillionaires in your day. It will happen. But well, you're already there. You got Bezos and others like 100 billion, 150 billion. You can see if you look forward, 10 years, 20 years, there will be trillionaires. And so I think it's just a process of everything getting larger. The successful become more successful. There's more money in the system. And so when you say, well, what about that? There's too many unicorns or decacorns. I just say that's just numbers right here. Things gradually get bigger. You could use different demarcations. Just are there too many, unicorns or decacorns? No, it's just everything's getting bigger, and it's more meaningful when you've got the bigger numbers these days. And when you talk about, I can make $1 million on a deal. No, that's nice, Ben, and it's nice to make $1 million, but you got to be talking about much bigger returns these days to get anybody excited.
Of course. And I think there's something interesting. I had a breakfast about a year or two ago with the man that was the CEO. He was, until the day before I met him, the CEO of AIG, big insurance company. And we were talking about this, that when I took my company public in '99 in the web bubble, they were one of the top 5, 10 most valuable companies in the world on the U.S. Stock Exchange. It was them, it was Exxon, it was Shell. The top 20 companies were old school, what many people would now consider dinosaurs, right? Still valuable, and now they're all tech companies, right? Because the difference between drilling for oil, there's lots of, by the way, negatives associated with that.
We have to oil companies. They will be speaking after us.
I'm not opposed to oil companies. I mean, it's unrealistic to get the energy we need solely from alternative sources, and it's great that we're doing more to get alternative sources, but the weaning process will be quite slow. But now, the nice thing about digital, I was talking to a company just the other day we decided not to invest in, that is, for lack of a better term, we'll just go with 3D printing houses. It's sort of generic. It's not exactly that. And it's like, so many moving pieces, so much regulation, so much uncertainty. I like something where you build it once and sell it 20 million times and there's no incremental cost. That's why people love SaaS. You spend an enormous amount of money, an enormous amount of time to build a piece of software, which when you charge $1 for it, you make 99 cents. After you've repaid everything you put into it, right? And so the trajectory of growth has fundamentally changed. And, like people talk about the Industrial Revolution to the tech, blah, 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 the way people live their lives is just fundamentally different. And so, yes, we're approaching these 8 billion people. And, it's funny, somebody made a great comment that this device, the Apple iPhone, is definitively different in many ways. But the analogy I love that they use is walk through an airplane. Coach, business class first. They're all holding the same phone, right? When has that ever happened, right? It's not like Louis Vuitton is the purse of choice for all choice. Okay, maybe counterfeit, right? But this, like $1,400 too. When we got my first iPhone and we got my first bill, I freaked out. I was like, what are you doing? How'd you spend all this money? It's just like, oh, it's so great. You could buy a flip phone for $20. And now we spend $1,000 a year.
And also now with all of our photographs and text and everything else, your life is on your phone. Yeah. And if somebody wants to rob my wallet or take my phone, I say, please take my wallet, not my phone.
And now, and with COVID, this is my wallet for paying for things. Anyway, everything, as things become digital in so many different forms, it empowers that much more. And then all the underlying infrastructure, and it was Snowflake has always done quite well, but we had a company at NEA that raised money at around $24 billion. And I was like, oh, wow. And then a buddy of mine called me and he said, hey, can I get some of that? I was like, you want to pay $24 billion for a company in a private round? He's like, oh, yeah. So I talked to some of the entrepreneurs around the space, and they're like, oh, this is going to be bigger than Snowflake. And I was like, maybe I should put some money in. Now, this is a guy who's in the 40 to 100x game that's putting money in at the seed round, but I was like, oh, I could use some exposure to a different asset class. That company then raised 6 months later at $33 billion. The only reason I'm sort of going with this is the reason I've gotten more comfortable paying higher valuations, 30, which I paid for the company I did so well with, versus 10 being way too high, is that the value of those companies has risen all the way through the cycle. And if you want to look at what venture wants to achieve, in my opinion, you start with public markets. What is the public market value? And then you just go downstream from there. Because, it's all feeding to the same place. No VC worth their salt, in my opinion, wants to fund a company that does not have a shot at having an IPO. And I will tell you that is a common misunderstanding for young people to get into the venture business, where they think, it's the thing I say to every entrepreneur is, if you think you can build something that Salesforce doesn't have, so they buy you in a $300 million tuck-in, don't take my money because I'm not interested. And then people it's funny, I won't name him because it's not really fair, but this guy who's been doing this for a long time, and we were at dinner, and he had this, multi-$100 million M&A deal fall apart. And he was like, I guess if there's not a chance for these companies to go public, I should never invest in the first place. And I was like, you just figured that out? You've been doing this for 12 years. Hello, what have you been betting on?
Different models here, but just to your point about phones and things, Tesla, that didn't exist 20 years ago, right? Now today, what they're worth, their market cap is worth more than Ford, General Motors, Fiat, Toyota combined. Just absolutely extraordinary thing. And so we're going to see this, and maybe it's not every night or over a week or maybe 10 years, but you're going to see.
Are they profitable yet?
Yeah. I think they had their first profitable quarter.
It depends which accounting you use.
Yeah.
Well, my point is that new companies and new industries come along, and the things that we used to count on forever, like General Electric, have all but gone away. General Motors went bankrupt, and so now we have big companies. We've got IBM, and then we got Microsoft and Google and others. Today, Facebook just changed their name to Meta, I think, because they want to change themselves yet again. The companies today that we value so highly are going to disappear over time, over 10, 20, 30 years. They'll go, and there'll be a new crop of people that'll be coming along. And so, Ben, what do you think the next thing is? Artificial intelligence or virtual reality? What do we do with all these tens of billions of dollars?
Well, I'm happy to take some of them, but because I need an opportunity fund, so $1 billion is useful. This is a very common question that I usually get from the entrepreneur that has just failed, right? So one of the things I say to my entrepreneurs is, I'm a one and done guy. Okay, I'm going to give you this money. You're going to rate. I'm not going to give it to you. I'm going to invest it in you. You're going to raise a round, and you're going to either prove or disprove a thesis. Now, if you prove a thesis and it's big enough, I can help you raise Series A. If you disprove a thesis, don't come back to me asking me for more money to figure out how to fix it. I'm basically placing my bet, to use a poker analogy. But poker is a very appropriate analogy to early stage venture investing. The wrong analogy, which a lot of people follow, is roulette. That is the spray and pray model, because it's a roulette wheel with 19,000 spaces a year. And if you really think you're going to hit Google, I can tell you some stories about why you're not. You're certainly not going to hit Facebook. There was one angel in that one, I think, and he got to put in less than $100,000. Made $19 million on it, not too shabby. But how much do you think the second most influential angel in the world got into that deal? I already told you there was only one in, so they got zero. So what they usually will do is, the other thing I do say, though, is, look, I'm not going to give you a second shot if you screw up and it doesn't work, or if it's nothing to do with you, it doesn't work. But if you spend half my money and fail, and you know it's not going to work, I don't expect you to give me my money back in a refund. Go try something else. I don't want you to have to pivot, but if you've got 50 cents on the dollar, I bet on you, keep trying. And so usually when that happens, it's only happened like half a dozen times, they say, okay, well, can we sit down and brainstorm? And they say, what's hot now? And my response has always been the same. That's the wrong question. You got to figure out what's hot later. Because what's hot is what entrepreneurs figure out and becomes exciting over time. You have to be too early by at least a bit. So I think that, my whole goal in life is to be a receiver. I want entrepreneurs to pitch me. I'll see 2,000 pitches a year. I want to wait until I see the pitch that makes me say, wow. And usually, wow is something I either didn't think about.
Before we go there, I want to touch upon this tolerance of failure, because that's what people are saying all over the world, that Silicon Valley is Silicon Valley because people are allowed to fail. And I always wanted to ask, okay, so you lost me money once, twice. Do we really like when people fail? So when did it come?
I don't like it. It's just, okay, so I like to tell stories because I think it's a good way to communicate and because I think it's the most honest thing you can do. I was at an event with a founder of mine, and this LP comes wandering over, and we're talking, and I'm interested in knowing LPs. This is before I was raising a fund, And I was telling a story about how I made 30 times my money on a company and how unhappy I was because the board was weak and they didn't support the founder who had finally exited the atmosphere and finally had a shot, and they forced him to sell. Here I am whining about making 30 times my money. And my entrepreneur turns to the guy and is like, I have never seen somebody that complains so much about making so much money. And I was like, yeah, Zach, but what did I say to you when you lost all my money? And he turned to the guy and said, he's right. His words, not mine, I peed away all of Ben's money over 6 years, and he never said a word about it. Because it's the nature of this game. You cannot get 100x upside if you're not willing to take 100% loss as a downside. I do not enjoy losses. I would much rather you just succeed. Do failures teach you things? Sure. I'd rather you skip those lessons and just succeed. Succeeding teaches you things too, right? But yes, it's a very tolerant community. Am I as likely to? I mean, the people I funded twice usually are the ones that succeeded the first time, though.
Yeah, exactly. Well, I also think that it's not just the individual and the entrepreneur and the venture backer, but the whole ecosystem in your society. And hopefully we keep capital gains here, and hopefully in Silicon Valley it will always be great to be an entrepreneur. But that's not true in many parts of the world. It's changing a little bit, but we have German LPs. I have good German friends, so I'll say in Germany, if you're an entrepreneur and you want to go to the bank to get funding because there's really no VC there, they say, I'd like 5 years of your financials. You say, yeah, but I'm a startup and I don't have any 5 years of financials. We understand, but we need 5 years of financials. and then if you fail in Germany or Japan or many other cultures, you never get anything ever again. It's like, it's one and done, but it's one and done in the other way. I think being able to fail, not failing, but being able to fail is what really makes this great here, to have that chance to go out and do something. And then if you do, you pick yourself up and you go and you do something else and you start another company.
There's also another reason why it's the right thing to do for so many people. One, sometimes failure for me isn't failure for the entrepreneur. There are these things called talent acquisitions. They don't happen as much as they used to, but I wrote a story for Business Insider basically that compares the announced acquisition of a startup without deal terms to, what is it, Schroefenberger's cat, the one that's either dead or alive in the box. I had 4 companies over the period of 6 weeks sell and announce in the press without bothering to tell me in advance. I was, I invested years ago, I was a small check, I get it. And in every case, I'm thinking, well, did I lose all my money? Did I get a refund or did I make a profit? So I reached out to the entrepreneurs. One didn't answer me. And I was like, uh-oh. So I reached out to him again. I'm like, now I'm worried. It's been a week. Did I lose all my money? It's okay if I did. I just need to know because my accountants need to write it down. And he's like, dude, chill out. You made, it was a 10X. I was like, oh, thank you. The next one was a 1X. The next one was $1.10, and then the one after that, I lost some money. But you never know. But net, I think most of the, well, certainly the venture capitalists I respect, if it's not working out, their goal shifts to how do we land the plane? And landing the plane means getting you bought or getting you jobs somewhere. And so I had an entrepreneur that failed in terms of having lost all my money, but he got a job and he said, I wouldn't trade it for anything in the world. He said, when I started as an entrepreneur, I was here as a, in terms of ability. When I exited, I was here. When I went into the company that bought us, I went in here. If I tried to go in there a year ago, I would have been going in here. He was fine, right? And so the ecosystem does look for that talent, and that is there. There's other things that have sort of contributed to it. One, we don't have, you can't unfortunately not compete here. There's a lot of theory that that's a big reason why Silicon Valley has prospered so much, and I think that's smart. When I first moved here, I was coming from New York, and I was like, it'd be interesting. What if I did factoring for startups, where I loan them against their, it's less dilutive, and wouldn't that be neat? So I reached out to a guy in New York I knew that did that sort of business. Said, hey, why don't we do this together? I'll find the startups and we can loan them money against their invoices. They're going to do a deal with IBM, they're going to have $1 million, but they need the cash. Let's loan it to them at whatever, 12%. And he's like, yeah, we can't do that. I was like, why not? He said, they won't sign PGs. And I was like, what? Personal guarantees. I was like, oh my God, I haven't heard that in 10 years. In New York, you're a startup? Yeah, okay, where's your house? Maybe I'll forego the 5 years, but would you sign here? I had only one outside investor in the company I took public in New York before I signed the underwriter's letter, and it was an accounting and consulting firm. And I was asking them, I never took debt, but I was asking them about this, and I said, so they take your house? And he said, actually, most of the banks don't, but these do. He said, part of our job is to tell you who not to take money from. These banks will take your house if you go bankrupt. These banks will let you keep going because they don't want to look like dirtbags. But just the fact that it actually was a conversation. Like, can you imagine? Here, startup land, hey, I'd like a couple $1 million. Okay. Obviously it's not that easy. Hey, I'd like to borrow some money too, SVB. Can I have another couple? Sure. Do I have to sign anything? Well, just the contract. What if it all goes wrong? Well, Good luck next time.
So Silicon Valley is here to stay because there's so many people saying that they can do it anywhere in the world. We have to discuss Sequoia, because what they're doing is changing something which has not been changed in decades. What do you guys think?
Well, actually, I think if I read the piece that Roloff wrote 4 times, it sounds to me like they're creating an evergreen fund. Sutter Hill did that before they did. I would love to have an evergreen fund. I ran my own business as an evergreen fund. I recycled 700%. At a 700% recycling, my returns are 40x. 10 realized, 40x total. But when I break it down into funds in 3-year chunks, I don't recycle, it drops down to like 14x. There's huge power in recycling. The thing is, like Sequoia, I have an enormous amount of respect for them. I will say a couple of things. One, they probably have the sharpest knives on the street, so I tend to be very careful about who I send to Sequoia when it's fundable, because one of my friends there was complaining. He's like, why do you give all your deal flow to NEA before I worked there? And I'm like, well, here's the spectrum of investors. Sequoia's over here, NEA's over here. You take a term sheet from Sequoia, they dig you a grave, and it's your job to stay out of it. If you screw up once, don't assume you can screw up a second time, right? Because you will be replaced, and that's that. NEA, you screw up, they'll give you more money, and then they'll do it again. It's crazy. But it's worked for both of them, because when you have what Dick Cranwick established as a no man left behind, no person left behind model, it ends up working out on a blended basis. Sequoia is fiercely logical. As far as they're concerned, as far as I can tell, there is no round in any of their best companies that anybody else should ever be able to touch. The downside of that for them, I don't think they care, is that when they send me a deal as a VC, I know there's something wrong with it, right? They'll put in seed, they'll put in A, they'll put in B, they'll put in C, they'll put in growth, and now they'll do post-IPO. Because their attitude is, and I will tell you from the inside that this is often the case, VCs look at their successes and say to themselves, why do we let other people put so much money into our great companies? And they'd like to put more in themselves. And so I think you're going to see a lot more of that. And an evergreen fund works really, really well, but you have to have the kind of access that Sequoia has. The reason they can do every round, which is the exact opposite of me, is they basically have unlimited capital. If you could only invest in 2 funds in the world, you would invest, let's say 3, 4. You'd invest in Sequoia, Benchmark, Tide, and then you'd obviously do IVP and NEA.
and of course, Ben, if you want to do the
if you want to be the seed game,
Ben
there's
right
only
here.
one.
Yeah, I would comment on Sequoia. First of all, I have tremendous respect for them. I actually knew Don Valentine before he started Sequoia, back when it was Capital Research. And he's just built an extraordinary organization over time. And there were 2 thoughts of school at the time. Do we back people or do we back markets? And everybody said, we back people, we back entrepreneurs. And Don just said, we pick big markets. I don't care about the entrepreneur, I just care about the market. Now, of course, he was overstating, but he had a point of view, and he built a great firm in the Valley. But I would say, stepping back, that there's other industries like ours that have evolved over time. The investment banking business is much older than ours. You go way back to the Europeans and the money they pulled together. But think back, we had what was Merrill Lynch, which went bankrupt, and Bank of America was forced to acquire them. Solomon Brothers, does anybody talk about Solomon Brothers? Blythe & Company. Back in the day, investment banking firms were all private organizations. And then DLJ decided to take themselves public, and then Morgan Stanley did, and then Goldman Sachs. So you have industries which grow, they change. One of my law school classmates, Joel Kirschbaum, got Goldman Sachs into the real estate business. Well, that was only about 30 years ago, but they were not in the real estate business at all, and today it's a huge segment of their business. So I think financial institutions, in this case investment banks or banks, evolve over time. I think Sequoia and Don and his successors are going to do a good thing here with the doing, and God rest his soul.
But do you think other funds will follow that restructuring? Or
I don't see it immediately. They might eventually. I think they're in a unique asset position. As Ben said, they've been very successful for a long time. But they're also, not just being open-ended, they're going to be publicly traded and open-ended, which presents risk. And so you can become a multi-trillion-dollar, publicly traded open-end fund. But if the market turns
they
down,
will not do publicly. No.
Well, they're going to be an RIA, but are they going to be public?
His wording was a little vague.
Well, it was
that
that you
part.
could redeem quarterly.
They said it was liquid.
Okay.
Right.
But,
Not freely tradable, but you could redeem quarterly.
Okay, well, so fine. I'll put my hand up to take somebody else's redemptions in Sequoia. Let me know when you want to sell to me.
We'll see what happens when markets turn, because markets always turn right here. So your strategy is right, but if you're there and you're running this and it's 2008, 2009, and the whole world's going to hell, and you've got a fund that can be redeemed, you're in a difficult spot. So I don't think everybody's going to follow. I think some will. Sequoia's a great leader. I respect them, but I don't think everybody will.
What they will
and
do
they're
is
raising the
growth
tax issue
funds.
right here, which is, can I convert all of my carried interest on my various funds before the tax law changes on January 1st? So there's a little bit of the end of year, let's rush and get this put in place. A lot of subtlety there. I'm not sure how that's going to work out in Washington, but they're trying to get it all done.
Perfect. Well, thank you both so much. It was fun.
Yeah.